Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. With the Bank of Canada set to raise rates as early as March, I wanted to do a brief video showing how far the interest rates have already come since this time last year. There have been a number of arguments put forward saying that we are set to see house prices not only cool down, but potentially drop by up to 20% when we start to see interest rates rise. Those arguments are based off affordability. Not only just mortgage qualification, but how much people are actually willing to outlay out of their own personal budgets for a mortgage.
I don't care what it takes or costs.
As we've seen the Canadian real estate market go up and up and up throughout 2021, and it's looking like in 2022 as well, I just want to take a brief look to see how much interest rates have risen and whether or not they've had an effect on the price of houses in Canada. So what we'll do is we'll look at the insured rate, the insurable rate, and the uninsurable rates in 2021 and compare them to what they are 1 year later in February of 2022. We are set to have more updates out on the Canadian real estate market this week, and we are expecting the inflation data for January to come out next Wednesday. The inflation data will have a direct impact on both the timing and the severity of the interest rate hikes coming down the pipe from the Bank of Canada. So we'll obviously have updates out on that as well. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. So despite the Bank of Canada maintaining its key policy rate over the past year, we've seen a dramatic rise in interest rates in just 12 months. In February of 2021, my best insured rate, insured, that's where you pay for the mortgage insurance, but you can put down less than 20%. The best rate as of a year ago was 1.54 for a 5-year fixed. That rate has risen dramatically over the past year, up to 2.79 on a 5-year fixed mortgage. That's 5-year fixed over 25 years, less than 20% down. So in just a year, we've seen rates go up on insured mortgages with less than 20% down by over 1.2%, despite the Bank of Canada maintaining its rate, meaning the bank's cost of borrowing did not rise whatsoever.
Nice to have money.
But as your cost of borrowing and my cost of borrowing, everyone else's has risen quite a bit. The insurable rates, that is where you have to qualify based off having under 20% down. You have to qualify based off of 25-year amortization. Qualifying at the Bank of Canada rate right now is 5.25, but you actually do have 20% down. That rate has also risen substantially as well. Last year, the best insurable rate was 1.74. And that rate has gone up to 2.94, and that's just in 1 year. So again, we see a 1.2% rise in interest rates, despite the Bank of Canada keeping its rate the same.
I got friends in high places.
Finally, uninsurable. Uninsurable, that's where you qualify with at least 20% down. You either have a 30-year amortization and or you take money out of your house. So it's either you purchase with a 30-year amortization or you refinance, take money out of your house for debt payoff, debt consolidation, renovations, upgrades, cash flow, etc., etc. Last year at this time, the best interest rate we had was 1.84. And that interest rate has risen as of yesterday, actually, up to 2.94. So we see a 1.1% increase in the cost of an uninsurable mortgage. So you don't pay the mortgage insurance and you amortize over 30 years or take money out of your house. The cost of borrowing for that has gone up by 1.1%. So in just a matter of 1 year, we've seen rates all across the board rise up well over 1%, 1 to 1.2% just in 1 year. And I mean, I think that really flies in the face of what we're hearing from a lot of the experts, that when we see rates rise, we're going to see a major crash in house prices, as even with these rates going up over the last 12 months, it doesn't seem to be affecting the real estate market, with 26% increase in the price of Canada's real estate last year alone. And by all accounts, prices all went up in January as well. Just in my hometown of London, Ontario, between December and January, prices went up by over 11% on our average price. So while we're hearing from multiple experts that these rising interest rates could essentially crash the housing market, depending on who you listen to, we've seen quotes of 25 to 20% drops. It doesn't look like interest rates have had any effect on that over the past 12 months. One thing I do want to mention though, although interest rates have risen by 1.2% depending on the product, the qualification standards still remain largely the same. So there's a two-pronged argument when our experts say that a rise in interest rates are going to decrease the buying power of Canadians. The one argument is based off your pocketbook, in that Canadians aren't going to be willing to spend so much out of pocket once interest rates rise.
No, not going to happen.
So once your cost of borrowing rises by 1%, you're less likely to want to make those monthly payments. Obviously, this isn't the case over the past year. The second argument, though, is that the rise in interest rates will lead to a rise in mortgage qualification standards. So up until now, in order to qualify for a mortgage, you had to qualify based off paying 5.25%, or your contract rate, the rate you're paying, plus 2%. So right now, with the highest rate at 2.94, you would either qualify at 4.94 or 5.25, whichever is higher. So obviously, you would qualify at 5.25. But as rates start to rise over and above that 3.25, your qualification standards will go up as well. So might have to, if rates are 3.5, you have to qualify at 5.5. If rates are 4, you have to qualify at 6. That very well could bring the market down. It depends how much the banks and the mortgage lenders respond to the rise in rates from the Bank of Canada. While a lot of the experts and a lot of the mortgage lenders will say that they're raising rates in anticipation of the Bank of Canada raising rates, clearly they've already factored in another 1.2% increase on the Bank of Canada. So time will tell how much more of an increase they start to factor in once the Bank of Canada raises rates, and that will actually change the mortgage qualification standards.
It costs a lot of money to make money.
For today, I just wanted to go over and for everyone to see how much rates have actually already risen, and that despite these rise in rates, these rise in the cost of borrowing, we're still not seeing much change in the Canadian real estate market, as Canadians seem to be more worried about what they can qualify for rather than actually money out of pocket. So time will tell. We will see as the Bank of Canada comes out with its interest rate plans in March, and as we get the inflation data out next week, we will see how much the bank is planning on raising rates, with some are already calling the Federal Reserve, to raise rates by 0.5%. So there is some momentum for the central banks to raise rates quicker and engage in more severe hikes than they were in the past, than they had initially planned to. But that will largely be dictated by the inflation rate and by our employment and our jobs numbers. We will obviously have updates out on all those, so make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.